Welcome to MarketTime.com. As always, nothing in this video constitutes a recommendation to buy or sell any security. Please do contact your financial advisor for any advice pertaining to your own individual circumstances. All right, in just a moment, we'll take a look at why this gentleman is holding $116 billion in cash. But first off, let's do a quick market recap, and we can see across the board that the major market indices dropped about 1.25%, just over that on the day. The S&P 500 down, the Dow Jones Industrial Average down, and indeed the Nasdaq was down. Yet, in spite of the volatility index rising on the day, and in spite of those big corrections in point terms, we also see that there was really no technical damage done. The bullish trends remained intact. The markets moved down towards their technical support levels of this most recent bullish uptrend. And so the edge still remains clearly with the bulls in the short term. All right, let's take a look at why, even though the short-term trend has been bullish, why this gentleman, Warren Buffett, is holding so much cash. And for those of you that remember back in 2007, Buffett was holding a very significant cash position. He was derided and mocked quite extensively in the media. Possibly Buffett's lost his touch. He doesn't really get it. There's a new norm. These were some of the comments that were passed because Buffett was not investing his cash. And right now he's sitting on an enormous amount of cash, $116 billion. It's enough to buy, one report was that it could buy the 25 smallest positions in the S&P 500 and still have money left over. So we haven't validated whether that is true, but even if it's close to true, it's a remarkable statistic. And so we wanted to dig into his portfolio and really get a sense of where the value lies in his portfolio and why he might be holding so much cash. What we see here is a fair market value distribution of his holdings. So essentially what this shows you is in Buffett's portfolio, which companies have upside potential based on standard valuation analysis and which companies have downside potential. So clearly this is, we're looking at the portfolio of one of the best investors around, and he's more often than not going to have a portfolio skewed with a lot of upside. Here we're seeing much more even distribution. So clearly he knows that well. And the interesting thing from our perspective then is to see, well, where is the value lying? What is this position in Buffett's portfolio? What is this position? And why might he be holding so much cash? Well, when we look to the upside, we see that that position there's actually a couple of stocks listed in there, but the one with the highest upside that we see is symbol SNY, Sanofi. And what's interesting about it is it has the highest upside potential, it has significant earnings per share growth projections, and yet is the smallest position that we can find in his portfolio, certainly the smallest reported one. Some companies, investment management companies, will often hold positions that do not meet certain thresholds required for reporting, and so they often remain off the books. In this case, this is one that's certainly on the books, but is the smallest reported one. On the flip side, if we take a look down here, what position has the largest downside risk based on a pure valuation analysis? Well, we see it's not that. It's actually Verisk. VRSK is the most overvalued position. I believe it's somewhere close to about a 35–36% downside risk in Verisk Analytics. And so then we wanted to take a look at a couple of other positions to see where the opportunity lies. Well, in this case, the fastest growing position in Buffett's portfolio is a company called Charter Communications, CHTR, while the position with the greatest analyst price target is Delta Airlines, DAL. So the reason almost certainly that you're seeing Buffett holding so much cash is that this skew has now turned, or this balance of distribution of companies in his portfolio is pretty evenly split. Instead of seeing a typical skew towards more upside, what we're now seeing is a fairly measured distribution between companies with downside risk and those with upside risk. And if you ignore the outlier here on the upside, you see it's very much an even split. And when that is the case, as Buffett has stated, there are a number of criteria that he looks for. He looks for good management. He looks for companies with a good competitive positioning. That relates to competitive moat, things like, does the company have perhaps a very strong network effect like Facebook would have, or does it, or Google indeed would have that too. Does the company have a low cost price advantage? Something like Walmart would fall into that category. And so there's numerous competitive advantages that a company can have. And really what the question to ask when you're examining a company like that is, if another competitor had just as much cash, could they still win the market? And companies like Google, like Facebook, it's extremely difficult to dislodge them. Even if you had 10, 15, 20, 25 billion dollars, you're probably not going to, for example, disrupt Facebook, because guess what? When you're on it, your friends are on it, and if you decide to set up the new Facebook, your friends aren't there, somebody else's friends aren't there, they're not going to join you, and so they all stick around on Facebook. And so it's very difficult for these competitors, whether it be Snapchat or Instagram, to finally take off and compete with Facebook. And when they do, what does Facebook do? Well, like in the case of Instagram, it buys it. So finding these companies with the competitive advantage is difficult. When you do, as Buffett surely does frequently, the question then is, can he buy them at a reasonable price? And he stated unequivocally in his most recent letter that he cannot find companies at fair prices, as in prices that he's willing to pay to acquire them. If he's not willing to acquire them, and you saw back in 2007 he wasn't either, he looked like a fool for quite some period of time. There was month after month after month, the markets were going higher. He was still holding his cash position, but eventually the tide turns, 2008 comes, markets crash, 2009 comes, and they continue to crash into March 2009 at the low. And what does Buffett do? Uses about $15 billion in the space of a few weeks to snap up some real bargains, get some fantastic deals. And of course, we fast forward about a decade and we see that he's in an even better position, has even more cash, and he's just sitting on it waiting. So if you're in the position of trying to figure out what to do with your cash, waiting is not necessarily the worst thing in the world. As some analysts will point out, there are two goals. One is a return on capital, and another is a return of capital. And sometimes a return of capital is more important than a return on capital, because the upside from the return on capital is small, the downside risk is high, and ultimately what it boils down to is a decision to reduce risk and not put a lot of money to work in terms of a bullish strategy. That doesn't mean you cannot take advantage of options. In fact, credit spreads are an excellent way to take advantage of volatility when the market's actually not doing a whole lot, but it's oscillating up and down between a range. Premiums are high, credit spreads are great, can take in a lot of money over a period of time. And of course, when they break out to a trend, the directional options, whether calls or puts, are very helpful. So with that said, hope you have a wonderful evening and take good care, folks. We'll see you tomorrow.